So you might think your hard money loan is being charged at a 10% interest rate, when in actuality, the effective interest rate is much higher. And how is that? Well, that's because you don't realize that your interest is being charged on the full balance of the loan, which is called Dutch interest. And in this video, I'm going to explain how it works and how to make sure that you avoid it, because Dutch interest can absolutely kill your profits. So in this video, I hope to give you a clear picture as to what Dutch interest is, so that you can avoid making these mistakes or finding out you've made a mistake until the end and it's too late. Most borrowers come to me focused solely on the interest rate itself. What's the note rate? But they're not asking the right questions, because what you also need to know is how the interest is being calculated, right? You don't want to find out in the end that the interest was being calculated differently than you expected it to be. Most people come in and think, a hard money loan is, just straight interest only, right? There's never principal and interest payments. It's a 12-month loan. It's not always that way. And there are lenders out there who calculate loans differently, and that can really impact your profits in the end, because usually you're not catching the fact that you overpaid your lender or paid a much different amount of interest until the end. And that's really when it's too late. So what is Dutch interest? It's when the lender charges you interest, a loan payment, on the full loan amount versus just the outstanding balance on the loan, the drawn amount. So with a construction loan, that matters, because oftentimes the lender will fund, let's say 90% of the purchase price, and then lend also 100% of the construction and put that into escrow. You as the borrower want to make sure that you're being charged on the balance that was funded at closing, or the balance as drawn over time versus the full amount of the loan day one, because the difference in loan payment and the amount of interest you pay during the loan term can vary dramatically in those two situations. So you as a borrower want to make sure that you're only getting charged interest on the outstanding balance of the loan, not the construction escrow, right? You want to make sure that that escrow is sitting aside with no interest being charged on it until it's drawn, which allows you to use your cash efficiently and make sure that you're not getting charged interest on an amount that you haven't even borrowed. How do we generally calculate the cost differential between a Dutch interest loan and non-Dutch? And let's use a very general example with high numbers, just because it's easy to calculate, right? Let's take a $1 million loan at a 10% interest rate. And let's say the loan is out for 12 months. And let's say the borrower is being charged non-Dutch from a lender like asset-based lending here. And the borrower is getting $500,000 towards the purchase of the property. And then another $500,000 in a construction escrow. And let's say they're just doing normal draws as a lender would expect. Maybe they're funding $50,000 draws a month in this example. And then they plan to sell the property a couple months later. They use 10 months to build and they use 2 months to sell. They're using the full 12-month loan term. In that situation with non-Dutch, a borrower that's borrowing $500,000 at close and then getting $50,000 in construction draws a month for 10 months and selling it out in month 12 is going to pay approximately $75,000 in interest during the hold. That's at 10% non-Dutch. In that same example, that payment now effectively on day one doubles, going over to Dutch. So now a Dutch payment is going to be fixed, in this case, at a $1 million balance. That's the full loan amount. So $8,300 a month for 12 months. And you're going to end up paying $100,000 in interest as a borrower for that same loan amount, but with two different interest rate calculations or loan payment calculations. So you have to understand how your interest is being calculated for sure, because right there is a $25,000 difference just in how interest is being calculated. Now, when you talk about the interest rate, the actual interest rate for a non-Dutch is 10%, because you're only paying interest on what you balance, and all the way through, that's the 10% rate. But with Dutch, that rate just doubled to 20%. Your effective rate is now 20%, because you're paying on $1 million day one and not the outstanding balance. Now, as an example, you can look at, a fix and flip. Let's say you were doing a $500,000 loan, and it was upfront, and you were going to have a $100,000 rehab, and that was going to go into a construction escrow. Well, that same analysis might be that you would pay 10% in a non-Dutch, and then an effective rate of, say, 12% in a Dutch situation, because again, you're getting charged a full interest on the $600,000 committed loan amount, and not just the balance that you're using over time. So you have to understand as an investor how the interest is being calculated, because in that example, that high level example, just the difference in Dutch versus non-Dutch is a $25,000 savings to the borrower in the end. And that's considerable. It applies to all different construction projects. And obviously, as the construction escrow gets larger, the difference in the delta between your interest rate and your effective interest rate is obviously much higher. So you definitely want to make sure that you're paying attention to how interest is being calculated. Talk to groups that don't charge interest on the unfunded construction escrow, because it really can make a huge difference in your profitability as a borrower investor. So the key takeaway here as an investor is to not just focus on rate. You know from my channel that I don't want borrowers coming to me always focused on rate. There's a lot to structuring hard money loans that go beyond rate, right? We can offer 0-point rates that are higher, and in some cases a higher rate makes sense. But in cases like this, where you're talking about deciding to go with lender A, Dutch, lender B, non-Dutch, it's really a no-brainer. You're going to save money, and to me, it's really not market for borrowers to be paying that extra interest, right? You as a borrower need to be using your cash efficiently to keep your borrowing costs down. And that to me is the name of the game. You need to use your hard money lenders efficiently. And that means using your cash to your advantage to keep borrowing costs down, to kick out draws so that you can minimize your interest carry. We want you to be doing more projects. We want you to do 2 projects at once, not just the one. And we know that you need to keep your dollars in your pocket and to keep the project moving in order to do more deals. So my name is Mike Chadwick, and thanks for watching the video. If you have any questions on Dutch interest or anything related to hard money, don't be shy, leave a comment. I usually respond quickly, and don't hesitate to reach out, email me or call me if you have a loan that you want to discuss, because I'm happy to help. Thanks for watching, and I look forward to the next one.